Good evening. Hello, everyone. Thank you very much for joining us. We're thrilled to have you guys with us. We have an exciting meetup today and a great speaker. And first, let me tell you a little bit about Denis and what our meetup is about. Can you guys see my screen?
Not yet.
No, not yet. Okay, let me see. I guess I did not share it. I think this will help. About now you should see. Perfect. Okay. So our speaker for tonight is Denis Shapiro, and his topic is debunking the myth about investing in affordable housing. Denis has built cash flowing portfolio, including many alternative assets such as notes, ATM funds, mobile home parks, life insurance, and so on. He co-founded an investment club for accredited investors in 2019. Following the success of his club, he also launched the SIH Capital Group, which provides accredited investors with a strategy to invest in alternatives. Denis wrote the Alternative Investment Almanac, a book that offers expert insights on building personal wealth in non-traditional ways in 2021. His book is based on his own experience, plus many interviews of some of the best alternative asset investors. So we are going to give Denis the floor in a couple of minutes. As always, the legal disclaimer, we're only providing this for educational purposes only. We're not selling anything. For any specific offerings, please consult your attorney or CPA. Our usual housekeeping rules, we ask everyone to keep yourself on mute. Once the presentation is completed, feel free to unmute yourself to ask questions or post your questions.
No.
Okay, who is not muted?
Sorry.
Yeah.
Okay. Okay, we've gone through that. And as always, if anyone has any questions or wants to reach out to the Matthew or myself, here's our contact information. Matthew is away on a business trip on West Coast this week, so he will not be joining us, but he'll definitely be listening to the recording. So with that being said, I'd like to give the floor to Denis. Denis, welcome.
Thank you. Let me make this full screen. Hold on. So today I'm going to be presenting affordable housing. My partner Anthony Khan, who's my partner on the affordable housing side, is also here today. So he's gonna join in. I know Alina only introduced me, but there is a slide where I'm gonna have give a chance to Anthony to talk. So affordable housing is an interesting niche in multifamily. A lot of people confuse it for different types of multifamily, like it's a value add, it's a class C, but it's actually none of the above. Affordable housing have their own very set characteristics, and we're gonna go over them. So by the end of the presentation that you guys will be able to see how affordable housing is different and how it's the same as regular multifamily. So I know Alina gave a disclaimer, so you guys are unlocked. You guys will get 2 disclaimers today. I keep these in every single presentation because it started getting annoying taking them in and out. Basically, we're presenting educational material on the concept of affordable housing. Affordable housing may not be right for you. Before making any investments, you should contact your financial professional, your tax professional, legal professional. So this is just the basic stuff. It's very similar to what Alina mentioned before. So today we're going to be talking about debunking the myths about investing in the affordable housing space. In order to do that, we need to take a journey. We need to first discuss how it's similar to other multifamily classes, and then we're going to actually get into how it's different. And then my argument is some of the differences are actually the advantages of affordable housing, and then we're just going to summarize everything up. So just like any other multifamily investment, so we're going to be going over in this part of the section, we're going to be talking about the same benefits. We're going to talk about a very hot topic right now is inflation. So we're going to talk about how affordable housing and multifamily, how they kind of both are a tool in fighting against inflation in your portfolio. And then we're going to talk about the importance of having the right team in place for any type of multifamily investment. So first, we're going to start off with the same benefits. So the first benefit is cash flow. As a limited partner in a deal, you are entitled to a piece of the cash flow if that building is profitable. So that works exactly the same way as an affordable housing does, as it does in a regular multifamily project. Inflation hedge. A lot of affordable housing, there's a huge demand for it. So usually the project usually has a very fixed long-term debt on it. And if that fixed long-term debt is lower than the average inflation rate, the property acts as an inflation hedge. So for example, around today, the rate is around 3.7% for like a 10-year product. And if the inflation stays at 5-7% like we've been getting, then the property gets cheaper every year by that 2, 3, 4, 5, 4% gap. Next is lower volatility. Especially if you're investing in affordable housing through a syndication, it's a private security. So you're not going to wake up in the morning and the building is going to be worth 10% less than it was the night before, just because of a geopolitical event or something else that's going on. Tax advantages, you are a limited partner, just like you are in multifamily. So when there is pass-through depreciation, it goes to the limited partners in affordable housing, just like it does in multifamily housing. Leverage, there's no specific difference. So it's not like affordable housing, you have to put more down. So it's around the same 20 to 30% range to secure that loan. So you still get that leverage of 70 to 80% on each deal, just like multifamily housing. Lastly, it's passive. So it's the exact same process. Once you do your due diligence on the operator and you wire the money, there's very little involvement for you as the limited partner in these deals. So inflation is such a hot topic. I wanted to give it its dedicated slide to it because the annual inflation, when I was actually writing this presentation only a few months ago, was only 5.5%. Now it's easily over 7%. Some investors argue that it's actually closer to 10 to 12% because they started counting inflation differently in the 80s. But the main point is that when you can obtain long-term debt that's backed by a physical property, that is one of the best tools possible to fight inflation. Why? Because you're taking on fixed debt, but as your mortgage stays fixed, you can actually pass on the cost of the inflation to the tenants. And besides that, that is a huge tool in your portfolio, because if you're just keeping your money in cash, then you're losing to inflation. When you put it in the property, you actually have a chance of defending your portfolio a little bit. So the importance of the right team. So in multifamily, the team that's in place is usually, there's two parts of a team. First part is the operating team, and the second part is the management team. Both parts are probably equally 50-50 in importance for the success of the multifamily property. So one of my favorite quotes in multifamily was given to me by one of my mentors. He said that a great operator can save the worst deal, a bad operator can ruin the best deal. So I'm going to introduce Anthony. Anthony's part of our operating team. So Anthony, I'll take it off with you because you'll probably introduce yourself better than I can.
Thanks, Dennis. Hi, everyone. I'm Anthony Kahn, and I basically got started in 2009 with real estate and really started ramping up when we started our LLC in 2014. And we're talking about affordable housing. So the first experience I had with affordable housing was in Philadelphia County, where I used to live in Philadelphia. Now we're just out in the outskirts, but that was in 2016. And then did some affordable rentals in Atlantic County in New Jersey, Delaware County in Philadelphia, just outside of Philly, and then now Chester County. And that's also where Dennis and I are doing one of our affordable deals in Chester County. So it's definitely a little bit more complex, but at the same time, there's so many advantages, and we're going to walk through that. So that's the avenue I decided to go down, and just meeting the right people to build and work with was really important for this area, because you also have to be, and then Dennis is going to walk through it, but you have to have experience and credibility in order to be approved by states and by counties in order to do these kind of deals. So I'll let him dive into it, but yeah, so KWW is our holding company though, and we pretty much have been selling off all our single family duplexes, triplexes, and smaller units to investing larger syndications like what we're working on now. Thanks, Dennis.
No problem. Our third partner couldn't make it today. His name is John. He's probably the secret sauce to our operating team because he has a property management background. He started, he's been a property manager for 13 years. He's 2 times property manager of the year with a company that has 38,000 units. So it's a very sizable company. He's managed over 449 affordable housing units. And with Oxford, with our latest purchase, he's going to be over 500. And he already has a relationship with Anthony because he's his current property manager on his current deal. I'm not going to repeat this, Alina. Basically, this is my introduction. So I'll skip this step. So the second part of that equation to a successful multifamily deal is the property management. So our property management that we partner with is MMS, and they have over 38,000 units. But the most important thing is, even though the 38,000 units is impressive enough, the most important thing here is the special division that they actually have. So they have a special division that handles specifically affordable housing, because you don't want a situation where your property manager is used to a Class A building that never has to do with income restrictions, all of a sudden being charged and be oversighting 100 tenants or 50 tenants that are going through various vouchers and programs. It will not jive very well. So your property manager is important, but even more important is a special division within your property manager to make sure that they actually have the experience needed to successfully manage affordable housing. So the current relationship between MMS and our partnership group started in 2018 when Anthony actually purchased this building right here. This building is an 18th century historical building that was the main hotel that was later on converted into an apartment building. John, who's our third partner, took over management, and we're gonna present this case study towards the end of what he actually did with the property. But it's just important to know that one of my golden rules, and I'm sure Alina has a very similar rules, is you want to avoid investing in an operator with a new property manager in a new location. That's usually a recipe for disaster. So you want to really vet out the relationship between the property manager and the operating team. So now we get to the fun part, the actual differences. What makes affordable housing actually different than any other multifamily deal that's out there? So the first thing we're going to talk about is actually key terms, just to introduce some of these terms because it's actually important. You'll hear them throughout the rest of the presentation. The first is LIHTC, that's low income housing tax credit that subsidizes the acquisition, construction, and rehab of the affordable renting housing for low and moderate income tenants. The subsidy places income restrictions for 2 consecutive 15-year periods. Now, the important thing here is these 15-year consecutive periods, because usually the first part of that period is usually held by the developer because there's a lot of tax credits involved and they usually want to keep it for a certain portion of it. Now, the second 15-year period is usually when you see a lot of these properties geared up to start selling. And it's important because the business model actually changes depending on how far you're in that 15-year cycle. And me and Anthony are going to actually show you an example of what it means to buy it towards the end of that cycle. The second key term is AMI, and that's the area median income. And this is an income figure used to help determine eligibility for affordable housing programs and is calculated on an annual basis by the U.S. Department of Housing and Urban Development, aka HUD. The most common AMI thresholds are 40, 50, and 60%. We're actually going to get into a little bit of that and what that actually means for the affordable housing industry. And lastly, we're going to be talking about vouchers. Vouchers is something you'll never really see in a regular multifamily deal, but we deal a lot of it. So the voucher actually provides a low-income household or medium-income household with rental assistance. The 2 most common vouchers are tenant-based and project-based vouchers. And we're going to go over our latest project on a couple of examples of how the breakdown came about and what that actually means. So the differences. So most of these I consider advantages, and I'll show you why. So the first one is a barrier of entry. In commercial real estate, almost anybody can go out there and buy an apartment building if they have some sort of money or if they have a network. It's not very difficult to go out, find a broker, and make an offer. But that doesn't necessarily mean that's a good thing. What ends up happening in a hot market is one commercial real estate project will go up for sale and there'll be 40 bids, 45 different operators. And then you have to question, is it really a good thing for the winner to be the winner in those situations? So affordable housing and income restricted properties are one of the unique asset classes that actually have a natural barrier of entry. And the reason why is because you have to be state compliant, and the state actually has to certify the sale. So what happens is a seller is not inclined to go through a broker, because the broker might get a bidding war, which is great, but that person who wins that bidding war might not have the affordable housing experience, and then the deal will get basically derailed at the last possible moment. So because of this state interference, so to say, it creates this barrier of entry where a seller is more likely to go direct, like he did with me and Anthony, and say, okay, we know Anthony is already certified by the state, has that approval. Let's just have direct negotiation with you. And because of that direct negotiation, we're able to get a much better pricing on the property. So that's the first difference, is the barrier of entry, and the sellers actually have incentive not to go through a broker in our situation. The second one is business plan is expense focused. If you've ever seen a webinar on any value add deal, it's almost the same thing. They go in, the apartments rent for $700, the average apartment in the neighborhood rents for $900. How are they going to bridge that gap? They're going to put the luxury vinyl flooring, they're going to put the nicer countertops, and then it's going to bridge the gap. It's going to make up that $200 a month. And if you multiply it out by the 100, 200 units, there's your business plan. This is completely different. In our situation, the occupancy for the most recent acquisition we're buying was 98% to 100% for the 6 months that we were in negotiation. What ends up happening is the income is fairly stabilized at that point. Where the opportunity actually lies is that a lot of these LIHTC buildings are built by developers and not operators. So it's not unusual for some of these new buildings built in 1998 to have operating expenses close to 80%, which is really unheard of. So that's where the opportunity is to come in and actually execute a business plan that involves cutting expenses. And we're going to show you some examples of how we cut these expenses. But it's a lot easier to cut expenses that are in direct control of you versus doing renovations and hoping that the tenants will come. So that's the second difference / advantage. The third one, again, I previously mentioned, is the vouchers and subsidies, because you're not really dealing with that in a regular multifamily syndication. So you have to make sure you have the property management that understands what the different vouchers are and what the different rules for the vouchers are. Higher occupancy rate. There's such a demand for affordable housing. There's usually waiting lists with the housing authorities for those local areas. So it's not unusual for an operator to buy a LIHTC deal with 100% occupancy, which is actually really nice, because the alternative to that is in a lot of multifamily properties, you will see the sale change hand around that 90% mark. And that 90% mark is significant because that's the mark that allows the agency debt to be placed on the property. And what ends up happening is, if you've ever been an investor on one of those deals, 3 months later, you start getting the first couple of occupancy reports and they're already down to the low 80s. Because what happened is the previous seller understands that that 90% is such a significant threshold. They start loosening up their restrictions and getting more tenants. It's called packing in the tenants. And you rarely see that with affordable housing, because there's such a strong demand for affordable housing that they have waiting lists. It's just much easier to have that higher occupancy. Next advantage is better financing terms. So one of the things that we found, yes.
Sorry, can I add to that?
Yeah, absolutely.
Yeah. And with regard to the occupancy, like Dennis just mentioned, we've had people in our other apartment buildings that they put unqualified tenants in, and then that was our headache when we bought it. You have to qualify for the tenancy when you're going through the housing authorities with the voucher program. So you're going to have a good tenant in there to begin with. And then, like Dennis mentioned here, there's wait lists. And if you work with the housing authorities, you can actually get on their website also and have that marketing come right to you. So it's basically like free marketing. So through that's another avenue where you can leverage and really just have a long wait list for your building all the time.
Great point. And we're going to get in how we use those wait lists as an alternative to spending money on advertising. It's one of the expenses that we actually are able to control with that. So the next thing that we're going to talk about is better financing terms. So the majority of the majority of debt for multifamily properties are done by Fannie and Freddie. And what we didn't really know is that there's actually a mandate for them that actually prioritizes affordable housing versus other multifamily deals. So in theory, if two deals go into the queue at the exact same time, the affordable housing deal will actually get priority over the regular deal. So we get expedited processing. And the other thing that affordable housing does is there's actually a different set of mortgage products that are only available for affordable housing. So we are getting a very special product. I believe it's and what's the name of the product? Like Freddie Mac affordable housing loan, something like that.
Yeah, it's an affordable housing loan, so you're several points lower than the market rate.
Yeah, so we got about 0.5% off in the interest rate because it's affordable housing. And then the last advantage, and this has to do with those two 15-year periods, is when the second 15-year period phases out, your buyer pool now completely changes, because one of the advantages here was the barrier of entry, which allows you to get that direct sale. But what ends up happening is there's a small buyer pool at that point, which is great for the buyers. But when you go to sell and the income restriction phases out, you no longer have that barrier of entry. And now you could sell to a much larger buyer pool. And we're actually going to show you what that means in terms of dollar amounts. So not all vouchers are the same. The types of vouchers that we had on our previous property, it was tenant-based vouchers, project-based vouchers, tax credit unions, and home units. So I'm going to go over, and do you want to go over these, or I can jump into them? But I know you know the vouchers a little bit better than me, so I don't mind you jumping in.
Yeah, I can kind of do the high level if you want, and then you can dig in a little bit more into that. And the like light tech, low income house and tax credit properties. So we have a 50 unit. They're all, the whole building is affordable. And with that, we have tenant-based vouchers, and that's the vouchers that stay with our tenants. So basically, if they move, they still keep that voucher and take it with them to the next place. We have 12 allocated project-based vouchers for this project, where it's actually tied to our property, which means they're more incentivized to stay with us, because if they leave, they don't have that voucher anymore. And those project-based vouchers, the incentive from the county is they'll end up paying us up to 110% of that fair market rent. So, say the rent's $1,000, we'll be getting 110% of that. And it's an incentive to keep that affordable space for tenants, because there's such a low supply of it and high demand for affordable housing. And then the home units is another layer program on top of that too. So there's many different things you can apply for. There's additional tax credits that can be applied for as well, and you can extend your periods further. But Dennis is going to talk about that too with the property that we're currently on. So you can take it from there.
Sure. So I'll start off with, there's also property, when I was talking to the property managers with affordable housing, what I started realizing is that there was a clear preference towards project-based vouchers versus tenant-based vouchers, because with tenant-based vouchers, the tenants treat their vouchers as like almost an asset. So sometimes when they get reprimanded, if they're not following the lease or anything like that, they get very confrontational because they feel like they have something of value, and that the landlord and the property manager should be almost thankful for them being there. This is completely reversed with the project-based vouchers, because project-based vouchers, usually the tenants are extremely grateful because they understand that if they do not follow the rules, they will have to leave, and that voucher does not leave with them. So part of our business model is always try to increase the project-based vouchers versus the tenant-based vouchers, but they both have their own unique characteristics. That's why our multifamily operators are not going to look at this. And if you see a rent roll with this, and especially that the income is based usually 30% of the person's income, the rent rolls are all over the place. So it's also a very complicated rent roll for other multifamily operators that are not in the space to actually understand. So tenant-based vouchers, just to summarize, usually it goes with the tenant. So sometimes you would get a tenant that's a little bit more confrontational. Project-based vouchers, you usually get a really high quality tenant. And usually if you need to warn them one time, usually those corrective actions usually just take care of any issues that come about. Then tax credit unions. So this one is actually interesting. This is basically if someone's not on any type of voucher, but they meet that 40, 50, 60% area median income, then they could have one of these apartments. What ends up happening is, let's say the rent is $1,200. the rent actually gets cut down to like $1,000, and they'll get a $200 utility allowance to be in that apartment. So obviously, as a landlord and property manager, you obviously want more vouchers in there because you could charge a higher rent. But that doesn't mean if a person off the street that comes through without a voucher can't get into that apartment. They could, as long as they meet that income restriction. And then lastly is home units. Home units is actually a little bit of a rare program. We kind of inherited with our most recent purchase. I believe it's phasing out in June, and then we'll have a option to either renew it or not. So the home units is actually a unique program where the government, HUD, is paying the tenant's entire rent, and the tenant's responsibility is to take that rent and actually save up for a down payment to buy a home. So the theory is you allow the person to get the down payment, and then they could get off the voucher program for life. So it's a very unique program. We are going to evaluate in June if it's worth keeping it, because there are certain incentives to the landlord. But just to show you how complicated it is, when we were buying this property, I believe the home units got revised towards the end of our purchase price, which affected our rent rolls and the T12, and we had to go back to the seller. So having all these different vouchers is a barrier of entry for other operators who usually never have to deal with any of this stuff. And like Anthony mentioned about the 110% of the fair market rent value, but these are the unique differences, because it isn't a simple deal like most other multifamily. But the good thing is, if you have property management that is familiar with this and they can navigate this, then you're in a great position. So we're going to give an actual example of what we mean by a business plan focused on expenses. So this is actually a snapshot of our most recent deal. When we went to acquire it, according to the T12, which is a running list of their current income versus expenses, they're currently operating at 76%. For a 1998 built building, that is extremely high. The normal should be in the 50s. So a couple of things that stick out, if you look over the expense list, if you look at the management fee, it's 9.76%. That is about double the average of a building this size. And the reason why it's this high is because the seller also had their own property management company, which was a separate LLC, but it fell under their umbrella. So they had no issues with paying a higher rate because there's certain accounting and bookkeeping benefits to that, but we have no incentive to do that because our property management is completely different. And literally day one, we cut that by, and what was ours, 4.5% by the end of the day?
We're at 5%. Yep.
5%. So we cut basically.
Yeah, and definitely, you could even get this at say 4% with big operators, but there's, like Dennis was saying, there's a little bit more to the affordable side, and there's compliance teams that are needed and other things. So, it's going to be a tad bit more. So we have additional staff that you wouldn't typically have with other properties.
But the bottom line is we're at 5% versus 10% on the previous T12. That's a $30,000 a year savings right there. Then if we go down the line for another expense that really sticks out is payroll. So payroll for 50 units should not be 120,000. It should be half of that. And then repairs and maintenance is high. So they're basically running expenses really high. Even if you see their building is 100% occupied, but they're still paying $5,000 for advertising fee, because we later found out in the due diligence process that they were not using the waiting list correctly. So these were little things that we were able to go in on day one and execute to bring down the expenses. So we're estimating a savings of about $140,000 in year one. So these are the major items that we're going to be saving on. That's advertisement. We're going to be using the waiting list like we've done on our previous properties. The management fee, that's already been contractually agreed upon going forward. Payroll, same exact thing. Repairs and maintenance, our property manager works with with a contractor. And do you want to explain how he gets the repairs and maintenance? John was telling about it last time. He has a really creative way of doing it.
Yep. So repairs and maintenance side, what you're seeing here in the red, they're actually doing a payroll. They have a maintenance tech on staff, but then he's also outsourcing everything. So the repairs and maintenance is so high anyhow. Our partner, John, runs his own maintenance team. So he has everyone there as 1099, and it's like the most affordable way to run this. So we're only paying for the hours we need someone, not when we don't need repairs year round. So, and he can bring in 3-4 guys to do a job. And, bang out a unit turnover in 3 days, 4 days for us. So that's a advantage that we have for quicker turnaround and also lower costs.
And then the last item is water and sewer. So sometimes with a LIHTC developer, they built this thing in 1998. So usually the electrical is top notch, the plumbing is top notch. What they overlook is they usually leave the original toilets, the original shower heads. All of these things in 1998 might have been state of the top of the line, but they have come their time, and the toilets are much more efficient these days. Everything, the shower heads are much more efficient these days. So we already have the water. There's water conservation experts come in. They kind of quote you out on what they can replace, and we already had estimates, and we're going to be saving about $25,000 a year on that. So that's going to be actually even more than this. So those are the type of savings that you could come in. And what I like about this is it has nothing to do whether or not the market is going to accept it, the fact that they like our renovation. These are things that we have direct control over. And this is what makes it unique versus other multifamily property. So this goes in line with off-market deals because of the barriers of entry. So because there's a smaller buyer pool during the income restriction period, the seller has to vet the buyer because the deal needs to be approved in our situation, because it's a Pennsylvania deal, by the Pennsylvania Housing and Finance Authority, and prior affordable housing experience is needed. So we are going through this process right now where we are getting that certification with PHFA, that's the acronym for Pennsylvania Housing and Finance Authority. But we more or less had it originally because Anthony already has a property with them 3 years ago. It's been running successful. He's got that experience. They are familiar with our property management. So it was more of a formality, but that's why a new operator is not going to come in and make a bid for this because of that uncertainty of being approved by the PHFA.
Yeah, Dennis,
so
and the sellers that we're working with, they have had deals fall apart because the buyers couldn't close because of qualifications, and they didn't have management that could staff it properly. They were trying to use regular management teams that didn't have any experience in affordable, and they got turned down. So that's definitely a huge thing to know about ahead of time. Yep.
So the above chart, that was actually done by a broker. So before we came into the picture on this specific property, they came in and just gave an estimate of what they would think if it got onto the market. So in this situation, I'll go to the next slide because it's the same chart. They had it estimated between $5.85 million and $6.45 million. The seller chose to directly negotiate with us instead because of the certainty that they would get with actually closing the deal. So in this situation, the broker wanted to list it at $6 million, and we were able to actually leverage a relationship to buy this property for 5.8, and then we lowered it down to 5.725 after due diligence. We recently got the appraisal back and actually came in at 6.46, which is actually really close to their stretch limit. So we were really happy with that appraisal. So change in buyer pool size, this one is really interesting. So it appraised at 6.46 million. The property was built in 1998, and between 1998 and 2028, those are the two 15-year periods. Now, the AMI income restriction is set to expire in 6 years. So in 2028, we're about 6 years away from that happening. What does that actually mean? So the same appraiser that estimated the value to be at 6.46 also said in the same appraisal report that once the AMI restriction is lifted, they expect the value of the building to be $8.38 million. So it's almost a $2 million increase just because the income restriction falls off because the buyer pool increases so significantly.
And Dennis, that 8.38 was on today's rents, not what the
rents on today's rent. Yeah. So there's a nice little. So as long as our business plan supports us holding it for 6 years, there's a really nice equity bump right there just for holding it for 6 years. Now, me and Anthony chose to structure this deal as a 10-year deal because of our concerns for inflation. But if we would have done a 6-year deal, the IRR would be through the roof because of even just this equity bump. So taking advantage of a smaller market, this is something really unique for affordable housing. Usually with multifamily, you know, the hot towns are like Texas, and I mean, the hot states are Texas and the Carolinas and the Georgias. That's where everybody's doing because it has high population growth and everybody loves it. And they don't care that they're bidding against 100 other bids on every single property. We're choosing to go to our back of the woods. And this is PA is about 2 hours away from me, about an hour away from Anthony. The population is small. So that can look like a downside. I'm going to explain how that's actually a positive in this situation. So the town is Oxford, PA. It's about 30 minutes south of Lancaster and about 60 minutes away from Philadelphia. It's a very small town. It's actually landlocked, where the surrounding area is all Amish farmlands. So the town itself is very healthy, but it cannot really grow too big because it's surrounded by acres and acres of farmland. It's actually a very, very beautiful town. It has a great little main street. It's a really interesting place. The other thing that's important to note is that the population is actually increasing. Lancaster has grown significantly and Philadelphia has grown significantly, and people commute from Oxford to both of those places. So it's actually a very healthy, small population. Now, if it was reversed, if it went from 5,600 to 4,300, me and Anthony would probably have to stay away because you're fighting too much in that situation. The last thing that's interesting is the potato chip company Hers. The family actually has their roots in Oxford, so they actually sit on the they sit on the board, the economic board, and you actually get some of the best potato chips and fries if you visit Oxford. So it's a nice little positive when we go on our business meetings. So what is the significance with affordable housing and small market rents? Because the rents are set by a locality rate. So in our situation, the rents are actually set by the Philadelphia MSA, which allows smaller markets to command similar rents to large markets. So we're able to charge the higher rents based on the Philadelphia prices, but we're paying basically a smaller market premium for those units. And that is extremely powerful because we're paying not the top dollar for these on a unit basis, but we're allowed to charge the rent as if we were. So that's what I call small market rent arbitrage. And the second biggest benefit is the low cost of living locations allow for an easier time to navigate the area of medium income. Because remember, we're under those income restricted periods. So we don't want to have a bunch of applications and then we're turning people away. When you're dealing with a small cost of living place like Oxford, I remember me and Anthony went there and we were able to go to an investor dinner and we had a whole 4-course meal for like $8. When you're dealing with that kind of cost of living and people's salaries are 30, 40, 50,000, it's very easy to fit them into these apartment buildings because they're naturally in that 40, 50, 60% AMI. Versus if you're building one of these LIHTC deals in the middle of New York City or Manhattan, sometimes you're turning away 100 tenants to get that one qualified tenant. So the last thing is LIHTC deals in the right market can operate very similar or even better to a market deal. And when you were dealing with a small rent arbitrage, we argue that it's even better in this situation. So additional information. So the main thing is we want people to rethink affordable housing. A lot of people confuse affordable housing communities with housing authority, and that is the furthest thing from it. So we don't have scenes like this in our community. We have these type of floor plans. So the pictures that I was showing you throughout the presentation, that's the actual affordable housing complex that me and Anthony had purchased. In this situation, this is the floor plans. Out of 50 units, 25 are 3 bedrooms and 25 are 2 bedrooms. The 3 bedrooms are all duplexes and have a very condo townhouse feel. They all have 2 parking spots for each apartment. They're great for families. They have a fully equipped modern kitchen with a dishwasher. They're large units. They're really an affordable alternative to a private house. They have washer and dryers in every single unit, and the resident gets to control their own heating and cooling. So it's a very luxurious feeling for affordable housing. So we're going to go over a case study of what this actually meant from an investor's perspective. So Anthony purchased the building he purchased Oxford Hotel Apartments in 2018. And if you saw the pictures, he basically painted it, keeping it in great shape. He purchased it for $1.15 million from the same seller that we purchased our 50 unit from. And at the time of the purchase, Oxford Hotel was only at 78% occupancy and was at 80% operating expenses. Again, the key here is the 80% operating expenses because that's a common theme. Developers know how to develop, and they're not exactly the best operators. So Anthony made the wise decision of bringing in John and MMS Group. Within the year, they got the occupancy up to 98%. At the same time, bringing down the expenses to 50%, which is an incredible feat for a building that's from the 18th century. Then the Oxford Hotels was recently appraised at over $2 million. The investors have received 50% of their capital back, and I believe there's another refi in the works, and then they're receiving really healthy distribution. The cool thing about this case study is that this is the same seller, buyer, town, and property manager as our other deal. Oxford Village Residences is our most recent purchase. It's a 50 unit. We're purchasing it for $5.725 actually $1 million. At the time of the purchase, the residence was at 98% occupancy, so it's actually a less lift than the previous deal, but a very similar operating expenses at 76%. We're bringing in the same property manager, the MMS group, led by John, who's going to be overseeing the property management. Within a year of acquisition, we're projecting to bring down the operating expenses to around that 50% level. And then we recently got it appraised at $6.46 million. And lastly, I want to leave off with this image. So Oxford is a landlocked town. So in the back of our apartment complex is this horse farm. And it actually has horses. And I joked with Anthony the first time I went to see the property. I was like, our tenants have this built-in amenity that they could just walk literally to the end of the parking lot and get to see these beautiful horses. And it's just absolutely stunning. And so this is how I like to leave the presentation, where this is what I want people to think of when they think of affordable housing. So thank you guys for your time. We'll open it up to any questions and answers. My website is shcapitalgroup.com. Anthony's is kwwholdings.com. I could share this presentation with Alina, so you guys don't have to like write this down or anything like that. And we welcome any questions. And I'll stop sharing.
Thank you very much. Thank you, Dennis. Thank you, Anthony. This was amazing. Dennis, either I forgot you or you didn't mention to me that Anthony is joining you. I would definitely have introduced him. I absolutely would not have missed that. But this was awesome. Thank you for doing it, guys. While we're waiting for questions in the chat, or if anyone wants to unmute, I guess I'll start. So if anyone wants to get involved with affordable housing, what would you suggest? Because a lot of people have this preconceived notion, I would say, that every time you deal with the government, whether it's state or federal, there's always a long wait. And it's always a challenge to knock on a door and get through that door to get some sort of response. What was your experience first time around, and what would you do differently next time? Either one can answer.
Yeah, Dennis, I'll go if you don't mind. I started off with the ones and twos, pretty much working with the affordable space and the different counties, and that wasn't the best experience. But as I started to learn more, I started digging in, and I took one rental unit in it was Delaware County, and I'm working with the county there, and I've got to say, working with the government in general. No offense, Dennis, but it's slow, and you got to be patient because you have to follow up multiple times. It's not like working in the private industry. So I had a rent on a single family out there that was like $700, and now I'm getting $1,058, and that's just in 2 years. So I was able to bump it up and get it to market rate because the previous owner had never raised the rent on their tenant. So you can do those things, and then it doesn't impact your tenant because if it's always based off their income versus what the average rent is. So maybe my tenant's rent went up $30, and then the voucher took care of the rest of it. Where this is really, I guess, the best way to leverage it, the Oxford Hotel down the street from the 50 unit that Dennis and I are purchasing, the rents I have there that's a senior housing building. And 70% of our rent is covered through the project-based vouchers. So the whole COVID period, this was my best performing property out of everything. And like Dennis mentioned, the tenants do not want to lose those vouchers because a lot of them, that's 70% is being paid by the housing authority, 30% is being paid by the tenants. Who wants to lose that and have to come out of pocket with more rent, right? So, maybe we had some tenants fall behind 2 months at the most, which was maybe $300 for us. It wasn't that much because the tenants were paying so much less. So having on the first of the month, that big check come in is huge. And I think for the 50 unit, we're gonna be probably around 40% for the voucher program, and that's gonna keep going up as we take over the property.
Yeah, and I'll give a very similar, but I think Anthony, when he got into the single duplexes, he kind of went the slow route and building up to the affordable housing. I had my first property ever was in East Orange, New Jersey. and I bought it in a low income area, Section 8, and it was such a bad experience is why I went so passive, and I went to the note funds and the ATM funds because I didn't want anything to do with that. It wasn't until I actually met Anthony that he kind of retrained me and saying, hey, affordable housing, if it's done right and it has the right property manager and the right team, actually has all these different advantages. And it was my relationship with Anthony and Anthony's kind of tutelage that actually changed my mindset, because I was looking at it from a single family rental, and I wasn't looking at it from a beautiful blue collar community that looks like a Class B asset in North Carolina. And that change of philosophy I owe to Anthony. So it's just about changing that mentality of that, what is affordable housing. And when you're dealing with one-off Section 8 properties, that is a very different experience. When you're dealing with a property manager that is familiar with affordable housing, it's a very different experience.
Yeah, one thing I'll add to that, when you are dealing with the affordable space, there's also annual inspections of your units. So that's another cost sometimes because there's more things to fix, and depending on the inspector, it could be tedious things, but regardless, that helps you also upkeep your property. So we look at it as a way as having extra eyes on our property, and tenants break things, we are going to charge them back. Sometimes you can't always, depending on what they are, but that's another difference you should know.
Sure. Anthony, you said it was annual inspection. Is it state or town dependent, or is it nationwide?
It's pretty much done by the counties, but it's across the board so I'm pretty sure it's nationwide, because our New Jersey and PA ones, which are the only two states I've done it in, require annual inspections.
Okay, got it. I see Chris on video. Chris, there are a couple of questions in the chat I'm going to ask. I know you have a question, so let me ask those and then I'll let you take the floor. So Shaniko is saying this is awesome. She's asking, is there a website to get involved in this type of investing, I'm guessing? Any recommendations for Shaniko?
Shaniko, are you looking to invest in like a single family in affordable housing, or are you looking to invest with syndicators that primarily focus in affordable housing? Just to kind of clarify that before I answer the question.
Syndicators that focus on affordable housing. I'm in New York, but I'm willing to step out of New York if it's like how you, in your presentation, you said like the smaller towns with the smaller populations and stuff like that.
Yeah, so me and Anthony are obviously syndicators in the space. There's not many out there because we kind of mentioned the whole barriers of entry. So would be more than happy if you want to reach out, and we do these type of presentations on affordable housing. We plan on doing more and more of them. So definitely, feel free to reach out to us after the presentation.
Okay, sounds good.
Thank you. Next question is from Sukim. First, is the rate of litigation higher for your properties?
When you're saying litigation, just lawsuits by the tenants, is that what you're indicating?
Yeah, actually, I am speaking about whether it's from the tenants or whether it's from a government agency.
Mm-hmm.
As you were speaking about it, by the way, it was a great presentation. I'm just curious if there are, I'm thinking there's potential, right? There's more potential for potentially being sued. And I speak about this from experience having a property in DC.
Yep.
So I'm not from your area, with just a host of things, right? So that's
no, and that's a very good point. So insurance wise, it is looked at as a higher risk for the affordable space because there's potential for more lawsuits, I guess. So that's a risk factor. John, our partner, he had a building that was probably about 60% inhabited, and it was really in bad shape when he took it over. It's like almost a 200 unit, and they were in litigation from the state because they were actually performing so bad that the state was looking to take over the property and basically take it from the owners at that point. And he came in and actually turned that whole thing around in just over a year. And it's a cash cow now for them. So that can happen with bad operators and people that don't know how to steer clear of that, and also deferred maintenance, those kind of things. So definitely upkeep on your properties, and which could happen in any other space as well. But to your point, it's looked at as a slightly higher risk with affordable housing, though. So that's one thing you can figure in. Your insurance cost might be a little more depending.
Awesome. So do you want to ask the rest of your questions instead of me reading it?
Okay, yeah, I see them now. So yeah, one of the other questions was about security. So we do put cameras. We have alarm systems. The one Dennis was sharing, they're townhomes. So you don't have a common entrance. You don't need central fire alarms or anything like that. So it's all individualized, and they're up. You have sprinkler systems in all your buildings. This is not. It's a different type of affordable housing, like Dennis was saying. It's not necessarily your projects in Chester County or New York area where it's dangerous. So there are different types of properties that we're looking at, and there's programs also that you can focus on, maybe geared to senior housing. Like I was mentioning, that 22 unit down the street we have is a senior housing building. We don't have crazy issues happening there at all, like you'd see in certain other cities. I think the areas and most of the things we're focused on here is project-based vouchers. And like Dennis was saying, that actually helps people be on a better behavior because they don't want to lose that. And that's the case for both of these buildings.
Do you see the question about the conditions of removal of AMI stipulation? And
Right.
maybe,
So
Anthony, explain what AMI, maybe not everyone understands.
yeah, the area medium income that Dennis was talking about, where you have 40, 50, 60%. So that kind of income that they're making is maybe lower than the market average, right? So because of that, they're going to have maybe a $200 discount on the rent. So that's what that's about. And what Dennis was mentioning, when if we were market rate on everything, the building would be worth a little bit over $8 million in today's rents. In 6 years' time, when we get to that 30-year period, we have the opportunity to go off the remove the AMI, or we can renew it and stay on for another period of time and get tax credits. So that's our decision on how we want to run this. And the project-based vouchers we can actually implement more of, take it in senior housing, veteran housing, those areas as well. So we get that market rate plus more. So there's a lot of options and choices that we have at that 6-year period, whether we want to stay on the program or not. And it depends on what the state housing authority, Pennsylvania Finance Housing Authority, who's the one we're working with, what programs and offers they have. So we're going to have to weigh out the difference between additional tax credits and go market rate, and what's the biggest benefit based on that area. And bottom line is we're not looking to remove tenants from the property to increase market rate. So we're looking to do the best thing to keep it affordable for people. But there's multiple choices that come into play at that in 6 years.
Yeah, and a lot of that is going to also deal with our business plan at that point. Our goal right now is to hold it for 10 years. But if we get into year 6 and let's say the interest rate is 6-7%, and we have this great product at 3.5%, we'll get a significant premium. So combined with the premium we would get because we're holding the right debt, the premium that we would get with the AMI restriction falling off would probably be too much for us not to sell the property at that point. And if we were going to sell the property, we would let the restrictions phase out so we could get the maximum premium. Now in year 6, if the interest rates have adjusted, or we're not seeing much opportunities out there, and we're going to hold this property for another 10 years, then maybe we'll be incentivized to lower the tax credits so our cash flow can improve, and then we'll hold on to the property in cash flow. So it's really a win-win situation. It's either we get a larger windfall or we get larger cash on cash. And a lot of it, the good thing is we have only 20-30 investors on this deal. So we'll really get the kind of voice out and hear what people are asking for. And if it works and we can align it, and people are saying, hey, we really just want that cash flow, we don't want that quick sale because we don't know where our next investment will be, then maybe we'll be incentivized to keep it, or vice versa. But the beautiful part of it is it's the options that are there.
Yeah. And one other question, or I guess to help people understand the affordable space. So the state, there's a HUD, which is your House and Urban Development. That's our federal level. they send funds to each state, and that's what's allocated to each county. So we're dealing with the Pennsylvania Finance and Housing Authority for the tax credits, and then the Housing Authority for the local county. And the local housing authorities with that county is the one that deals with the vouchers. In 6 years' time, the barter and chip for the state is those tax credits and what they can offer us to keep it affordable. They want to keep everything affordable because there's such a limited supply, and they can't afford to, we can't go build an affordable building without those tax credits, because everyone knows it's not going to make the profit. That's why you see everything nowadays that are built are A-class properties, right? Because that's the only way to make your money back with those kind of rents. So that's why the tax credit program is in there, to encourage people to have these properties to supply for the affordable, the large demand of affordable space that there's such a high demand and low supply.
And Suk asked, does bonus depreciation also apply to these types of properties? So yeah, it applies exactly the same way it would for any other multifamily. Now we're going to be doing a 10-year hold, so it might not make sense to us to do a bonus depreciation right away, but we would do some kind of cost segregation and maybe, end up at 25 to 35% type losses for the first year instead of shooting for that higher 40, 50%. That's just because our hold is not expected to be 3 years. Like bonus depreciation is really good on shorter holds because in the later years, you're not going to run into like a taxable event early on versus a long-term hold. You might not want to use all your depreciation in one shot.
And when you have the major renovations, you're going to be able to leverage that bonus depreciation much quicker too.
Awesome. I think Chris had a question. Chris, you still there?
Yes, I'm still here.
Go ahead.
So thank you for the presentation. I had a couple of questions. My first question is about sort of the factors for considering and investing in multifamily assets that are affordable housing in the markets that you're investing in. You did cover these populations, and these are not huge population centers, they're smaller, but what are the key factors that you're considering there? Do you look at some of the same things like job growth and other types of inflows and outflows to making your decision, or are there other things that you're looking for?
Yeah, I'll take that one, Ant. So there are the basics that all multifamily should be looking at: income growth, population growth, and crime. We tend to stay away from high crime areas. So if you look at Oxford in the map, there's certain apps out there that will actually map it out. So you could actually see what the median income is and what the crime rate and all of that stuff. So that stuff checked out really strong for Oxford. And Oxford is actually surrounded by a large area that has a median income of over $100,000, which was really nice to see. The other thing is you could kind of almost apply like a Starbucks effect here, where the developer that we're buying this property from, they're the largest developer in the state, and they do tons of research before ever putting a property in a place. So it's kind of like if you're going to open up a new coffee shop, you don't really need to reinvent the wheel. If it's close enough to a Starbucks, you know that there's demand for higher quality coffee. So in this situation, this developer, the largest developer in the state, came in 1998 when the population was only 4,500, looked at all the demographics, all the population trends and everything, and said, okay, we could support a brand new 50 unit right here because the next 30 years look good according to their research. So in 30 years, basically 23 years later, fast forward, the population has only gone stronger. It's increased by like 20%. The income has very steadily increased. It's not like a booming hot market. It's not your Dallas, but it's just a solid smaller market.
Yeah, and to add on to that, like your rent increases, for instance, 5 to 6% might be our maxes. Unless it's really way below market rate, we can actually apply to have that jump, like I did for the other one, going from 700 closer to 1,000. Your development markets, Texas, Florida, like the states Denis mentioned, you saw some rents jump like 12% and stuff like, and even more in some areas. But that also that's a risk reward kind of thing that you're doing with it. This is very steady and stable.
Got it. Thank you very much. And my last question is, you guys mentioned that you guys formed a partnership. And if I missed this at the beginning, my apologies, but can you talk about how you guys formed your partnership, and then how you went about building your team? Because finding, you know, like-minded individuals, especially in a more focused asset class like affordable housing in this sort of area, is really interesting. And I wonder how you guys kind of crossed each other's paths and built up this awesome partnership.
Yeah.
Sure. You want to take it, Ann, or you?
I'll start, I guess. Yeah. So the first, the one I had purchased down the street, the 22 unit, that's where John, who's our other partner, he was a property manager, and I've had 10 different property managers with all our properties in multiple states, but he's by far the first one that I've worked with that treats it like his own property. and you know, that having that and working with him for the past 3 years, I was just like, you know what, this is, and he also has his own rentals. That was a huge factor for like why he thinks like that, right? Because he has that background with his own rentals as well. So, and his level of integrity was just incredible. So I was like, he was going to invest with me, but then I said, wait, why don't we partner together? And Dennis, you know, we met a year and a half ago on a trip to a syndication we both did on a 360, an investor that we worked with. It was a 360 unit or so, 336 unit in North Carolina. We went on a trip together. That's how we met. And we were talking the whole time. 8-hour drive, and it was just like that wasn't even enough time to cover everything that we wanted to talk about, and we just continued that, set up weekly meetings, and just found that synergy with the path that we were both going down. And Dennis, you can add to that.
Yeah, I don't have much else to say. Yeah, honestly, Chris, I went through a lot of people, like networking wise. I usually get on maybe like 10 networking calls a week, so I've talked to a lot of people, so it's kind of like there are certain partners that I was looking for that really made sense continuing that partnership. It's not just about people who will take the time. It's about people who will take your time and then add to your time, add like value to your time. So the funny story, what Anthony didn't mention about that trip was that was during COVID. So my wife is an emergency room nurse, so it was a big sacrifice for her to, you know, basically allow me to go out on this field trip. And the funny story is I told my wife, like, hey, you know, I'm going to be taking this road trip, because I told the operators, like, hey, I really want to come down to your newest acquisition, but I don't want to drive by myself. It's 8 hours. And he was like, let me connect you to Anthony. And I actually think this is like that operator basically put all this in motion and connected Anthony. And literally we exchanged a couple of emails, but it was basically a blind date at that car ride when he got in, because it could have been a very awkward 8 hours. And within like 25 minutes, we were talking about life insurance policies. We were talking about all these like niche things that not everybody does. And then we had the whole 8 hours there. We spent 2 days. We basically hung out almost 2 days, but there was a lot of people there. We did a lot of networking. I think Anthony also observed me networking, which was a strength I think he was looking for in a partner. And then the really funny part was towards the end of the trip, I always get on quarterly calls with my investors, and Anthony was leaving. I said, let's set up a call. And I didn't specify quarterly. And Anthony was he set the initiative. And by the time I got home, I got a weekly invitation, and I didn't want to sit, and I was thinking, I was like, wow, a week might be too much of a commitment. But I was like, you know, this great partner of mine might want to put in that much time to our partnership. That was a real sign to me. So we agreed to the weekly calls, and very grateful that I did. And we both have really small kids, so our calls are like at 10 o'clock at night on Thursdays, and these calls went from like 10 to 12, and it was just really, really productive calls. Then we almost had a different partnership. I think Alina was actually involved as well. We were looking at apartment building in Georgia together, like those 5 of us, and we got on weekly calls again on that point. So we just kept working our way to it. It was definitely not like an arranged marriage. It was a very slow, calculated decision. And then he told me about Oxford Village the first day he was going out there, and I was going out to a different property that Anthony actually invested with me, but is not partners. He actually is my partner on that deal, but in a different sense. And, we talk on a weekly basis, and basically, Anthony has a very unique skill set that is very similar to mine, but different. He's much more attention oriented. I am not. I hate looking at contracts. I hate looking at leases. That is not my strength, but I could get on a call and I could talk and I could network and I could bring people together. So again, complementary, but most importantly, we actually like talking to each other, which I would say is like the most important thing.
That's awesome, guys. No, thank you for sharing that. I mean, it sounds like like a matchmaker almost, and you kind of went through all those different experiences to be able to link up to one another. I think that's really, really cool. And just, for someone who has aspirations of doing something similar, being able to, identify that right partner and the complementary skills, of course, those are some of the key things that they talk about that really breed success in this space. So thank you for sharing that.
And Chris, I'll just add, this wasn't like I had partnerships before that I had to dissolve. It unfortunately didn't, excuse me, it didn't work out as well as I would hope because people changed directions of what they wanted to do. So that also gave me better questions to ask and know who to partner with in the next thing that would have those, like Dennis mentioned, those strengths that would complement what we were working towards. So lessons learned as well to get you there.
Awesome. No, thank you very much for sharing. Appreciate your insights.
There are many lessons in partnerships, and some are good, some are bad, but essentially, Chris, you can think of it as business marriage, and sometimes it works out, sometimes not. But as one of other syndicators, they call it seminars, and some of those seminars could be quite expensive. I'm talking about attorneys and legal fees. But it's best to go slow, and think about this as dating period, and take your time to decide whether this person or this group or these partners are the people that you actually want to partner with. But it's definitely a conversation for another presentation. We can have a whole presentation on this, I'm sure, from many people.
Yeah, that's a great idea.
Yeah, we'll do that. Thank you, Chris, for that recommendation. Guys, awesome questions. Any more questions? I don't see anything in the chat. Anyone else wants to unmute themselves and ask a question? No, I think you guys covered a lot. Denis, Anthony, thank you so much. This was amazing presentation. As always, we're recording it, so it will be shared with everyone who registered. Denis shared their contact information, so feel free to reach out to either Denis or Anthony or both of them. And again, thank you very much, everyone. Have a great evening, and we'll see you at the next one. Bye, guys.
Thanks, everyone.
Awesome. Thank you, guys.
Thank you.